Hey guys, welcome back to another video. Today we're going to be talking about the 5 mistakes that first-time business buyers make when looking to buy their first business. And as a background, I'm a Canadian investment banker based in Toronto, focused on selling businesses within the $2 to $50 million enterprise value range. So I'm quite familiar with dealing with these types of transactions, and I speak to a lot of buyers and learn about their journeys and some of the mistakes that they've made along the way. So just as a starting point, there's a lot of information out there talking about how to buy a business and the process of going about buying a business. But there's a couple overlooked areas when it comes to actually getting the deal done. So a lot of these topics are going to relate to not the post-close, but the pre-close process for you to actually get that first business transaction closed. And so the 5 mistakes, just to summarize them here. Number 1, submitting short and unclear letters of intent. Number 2, overpaying or not structuring the deal to mitigate your risk. Number 3, the sunk cost fallacy and overcommitting to a bad deal. See this a lot. Number 4, underestimating the capital needs of the business to grow. And that includes both CAPEX, but also working capital. And then number 5, approaching the seller relationship as a negotiation rather than a partnership. This is another biggie. I see this a lot. This is not a movie. It's not a TV show. This is real life. These are real emotions. And ultimately, being steady and professional is always going to get you further than being aggressive on the negotiation front. So let's jump into each one. So number 1, submitting short or unclear offers. So the letter of intent is an important milestone that should be used to manage the seller's expectations. And the reality is a seller mentally locks in once an offer is signed. So whatever you put on that paper and that they sign back and commit to you and say, yes, I'm exclusive with you, they are agreeing in their head to those terms. So if there's any change to those terms or additions to those terms, those look like additional negotiation points that the seller didn't factor into their mind, even though from your end or from your lawyer's end, that may just be standard deal points. So really, we always lean towards more detail than less detail in the letter of intent. Even though it may be a little bit more overwhelming to understand, it at least brings those discussion points to the front end of the discussion and allows the seller to react and allows you to actually see how they react to determine, are these guys a realistic seller or not? You don't want to bring these topics up later on when you've actually incurred fees and you've spent a couple months chasing the deal to get it closed, and the seller all of a sudden decides, no, I don't want to sign a non-compete. So really those 1 or 2 page short LOIs can get you in trouble. We typically on our deals will see LOIs range from 7 to 9 pages and a lot more detail. So funny enough, if you're interested, I actually on the Finance Kid website, there are LOI templates that are available for purchase. So you can kind of see those 7 to 9 page offers as well. So you can click the link in the video description. But the first thing I really want to talk about is in every LOI, you want to make sure that you clearly define the valuation of your offer. So no ranges, nothing that's a little bit too vague, because that obviously is just not the right point in the process to do this, but also B, explain how you arrived at your valuation using an EBITDA multiple or benchmark EBITDA. So for example, if a business is generating $1 million in EBITDA and you're buying it for $5 million, then the EBITDA multiple would be 5. And you'd spell out, I'm buying your business for $5 million and I'm basing it off of a $1 million EBITDA benchmark at a multiple of 5. And what that does is it sets the valuation expectations for the seller, and it clearly explains how you arrived at that number, so that if that EBITDA number ever changes throughout the process, and say, for example, the business goes down to $500,000 in EBITDA, well, at that point in time, if you choose you still want to buy the business, you can position it with the seller as saying, hey, listen, I'm just resetting the EBITDA. The business is now generating $500,000. I'm still paying you your 5 times. Therefore, 500 times 5 is now 2.5 instead of 5. But this way, the seller clearly understands, and also the sell side advisor, my version of me in that room, are going to be able to have a better discussion with the client to say, okay, these guys look at it as a 5 times instead of a 6 times or instead of a 4 times. So the more detail, the better in terms of your multiple. And then as well, there's a couple other points that, in our detailed offers we want to see. The first one is working capital. So I have a separate video that goes into a lot of detail on this one, but very briefly, working capital are the current accounts, so the current assets minus the current liabilities that stay with the business post-sale. And so it's included as part of the purchase price of the business in order to fund the ongoing operations of that business post-sale, because you ultimately don't want to write an additional check to meet payroll on Thursday if you close the business on Monday. But It's important for you to bring that topic to the front end of the discussion now, because certain sellers may not understand it. B, help explain what is included in working capital. So current assets includes, accounts receivable, inventory, prepaid expenses. Current liabilities would be, accounts payable, accrued liabilities, tax obligations. And so what's included in that net working capital calculation? How do you arrive at that net working capital calculation, whether it's a 12-month average, a 24-month monthly average, whatever the case is? And then also define clearly that any old unsellable inventory or uncollectible AR is excluded from net working capital. And I've seen a couple of deals actually go sideways because this is mentioned at the end in the legal documents. And to the buyer, it seems obvious that that would be a given at the LOI stage, but they didn't put it in the LOI. And when they brought it up at the legal document stage, the seller reacted by saying, hey, that's a new clause. I do have some old and unsellable inventory, but I'm not going to take a hit on it. You're going to have to buy it. And it creates tension. So include those types of commentary in your LOI up front so that the seller either reacts then and you can really immediately see that they're unrealistic, or they process that information, they lock into that mentally, and they don't kick up dust later on in the process. Another big one is the non-compete. So most sellers have to sign a non-compete when they sell their business. And so you want to define clearly, what is the term of the non-compete? What is the geographic region that the non-compete encompasses? And what is the industry that non-compete relates to? So on average, I would say an average non-compete is about 5 years. I've seen it go up to 7, sometimes even 10. The geographic region depends on the size of the business, the scale of the business. Is it a national business or a regional business? So in this example, in Canada, it could be our province of Ontario, or it could be Canada as a whole. And then as well, the specific industry that it's in. So you don't want to say manufacturing, you want to say pet food manufacturing or metal cutting manufacturing, whatever the case is. And ultimately, you want to define this up front to say, hey, listen, as part of this price, I expect you to sign a non-compete. This is another one that comes up later on in the process that ultimately the seller says, oh, well, you know what? I needed more value to sign a non-compete or something like that. I was having a discussion with a client just yesterday where we gave a range on value. And this was earlier on in the process. And they were like, well, listen, if you're going to ask me to sign a non-compete, I want a premium to that range. And I countered and I said, well, hold on a second. That's actually not the case. If you don't want to sign a non-compete, then it's a discount to that range. But if you sign the non-compete, the range that we gave you is probably what we can get in the marketplace. So it's about, just managing expectations for sellers that are going through this process for the first time, similar to you. The other is the conditions of closing. So you want to spell out what do you actually have to do to get done in order to get that deal closed. Is it customer consent? So actually meeting the customer pre-close. When would you do that? What does that look like? Do you have to sign management contracts with a key staff? Do you expect them to sign on pre-sale? Are there lease extensions? So is the property owned by the seller, or is it owned by a third-party landlord that needs an extension? Are there inventory audits or environmental reports that need to get done for your financing as well? So just spell out all the things that you expect you need to deliver on that are key milestones, that are key diligence items. And so that way, when the seller says, hey, this process is really taking a long time, there's a lot of work, you can refer back to the conditions of closing and clearly explain, no, I'm just following the process as we discussed. I'm just getting the job done. Another one is a post-close transition. So what does the seller's role look like? How long are they going to stay on? How much do they expect to get paid for that transition period? How many hours are they expected to work during that transition period? And what is the intent of that transition? Is it just training of you? Do they continue on and manage sales accounts and or do pricing? The more specific, the better. Because usually as a seller walks towards closing, they're already thinking about retiring and slowing down and exiting. So negotiating the terms of their contract closer to closing becomes a little bit tougher. You want to address that up front, where mentally they're still focused on trying to be, more of a partner to help you get that deal closed than already thinking about the exit and slowing down and just, exiting the business completely. The other one is a real estate lease. So if the property is owned, you also want to clarify the terms of that commercial lease, assuming you're going to lease the property from the seller, and specify what is the base rent. Is it a triple net lease? What is the term of the lease? What does the renewal look like? Is it one renewal 5 years? Is it two renewals 3-year terms? What does that look like? The more detailed, the better. because at the end of the day, same thing, like a seller is going to start negotiating more and more. From a leverage point of view, you as the buyer, you ultimately have the ability to work more closely with the seller at this point in the process versus the seller, already looking to the finish line at the very end of the process. And there you have to push them a little bit more, and it gets a little bit more awkward to talk about these topics for the first time versus doing it up front. And then lastly, it's exclusivity. So usually an offer is between 90 to 120 days is locked up with that specific buyer, and that ultimately allows you to negotiate, do your due diligence, and feel like you can incur costs and not compete with other buyers. Ultimately, certain buyers or certain sellers may actually say, no, I don't want any non-compete, that I'm not going to sign any non-compete. Well, that's just not market, and you need to manage their expectations. That you, rightfully so, you're not going to incur any substantial costs if you know that you're not exclusive with that opportunity. Okay? So moving on to mistake number 2. So this is obvious, but unbelievably, even though it's obvious, there are still a lot of buyers that when I come and I help consult on their deals or they're just asking for advice, I look at it and I say, that's an aggressive structure. Or, that's a really high price. You're not getting a deal. Maybe you're paying at market or just above market, but why? And so, the mistake is either submitting an offer and having the wrong structure, where you're not really using seller financing to your advantage to mitigate some of the risk that you're taking on as a buyer, or you're submitting too high of a price. And so the most important topic or comment I can say here, and this applies to stock investing as well as private equity investing, is that you make your money on the buy, not on the sell. So what you pay for this business will disproportionately influence your final outcome in terms of the returns you'll realize 5, 10, 20 years down the line. If you overpay and saddle the business with debt and you have to start paying back a lot more than you should have, then probably the ability to scale that business gets reduced, and you probably won't hit the outcomes that you're looking for in terms of that transaction. So in a way, no deal is better than a bad deal. Just remember that. Because there's a lot of pressure. There's this pressure. You commit to buying a business. You tell everyone in your network. You tell your friends and family, I'm going to be an entrepreneurship through acquisition type entrepreneur, and I'm going to go and buy a business. And you almost feel the self-fulfilling prophecy of I have to buy a business. And as time passes, there's this compounding pressure to make a deal happen. But the reality is a bad deal is a bad deal. And in a way, it's actually more mature and smarter for you to actually not do a deal if you don't see that there's a good deal out there for the type of situation you're looking at. Now, to be honest, the number of fish in the sea are so many, I'd be surprised if you can't find a good deal. It's just probably you're not looking in the right places, you're not investing in the right time, or you're in a hurry to get the deal done and you're not giving yourself enough time to find that deal. So don't rush. Make sure that you acquire a business that is properly valued and the purchase price is structured that fairly. I'm not saying that you're going to take advantage of the seller, but at the same time, you shouldn't overpay for a business or give a lot of cash down and not leverage the expected seller financing that comes with a standard deal in the lower middle market. So, really from a buyer point of view, a lot of the times I see the reason why they rationalize paying a higher price is the sector, the growth story, and really all these different things that, this is an essential services business. It's growing really strong. So I'm projecting that if we do another 20, 30, 40% growth year over year for the next 3 years, I'm going to buy down my multiple. I'm going to bring down the 7 times multiple to a 5 times multiple because then I'll make a couple other acquisitions. And so if you're relying on future projections to bail you out of a currently bad price deal, don't do that. Because the reality is the economy could turn. You probably can't execute on that strategy because you're going to have too much leverage on the books anyways, and things happen. The reality is you can only control what you can control, but there's all these other variables in the economy that you can't control. So paying or overpaying for a business is a very common mistake that I see. So let's talk about structure as well. So on the structure side, on an average SME transaction, I would say anywhere from 20 to 30% of the price is in the form of seller financing. Typically, the bank comes in for 50%, the seller comes in for 25%, and then you put in 25% buyer equity into the deal. Now, that's in Canada. In the U.S., because of the SBA loan financing, typically now the buyer equity is 10%, 15% now in 2024 because of just what's going on in the economy. And then the balance is seller financing and bank debt. So there's a little bit more leverage in the US, but at the end of the day, you should not, pay too much in terms of cash down. So when I see certain deals where seller financing is only 10% or 20%, either it's a super competitive auction and you really bent a little bit to win that auction, or if it's a direct proprietary deal, the reality is I'd rather pay a higher price with more structure than a lower price with all cash, because at the end of the day, for you as a first-time business buyer, your risk is a lot different than the risk of a private equity firm that has a pool of capital to commit across several deals. And then just remember, the smaller the deal in terms of enterprise value, so say, for example, the purchase price is $1 million or $750,000, well, the available level of bank financing for those smaller deals declines. And therefore, the need to fulfill that gap with seller financing increases. So your average seller financing actually increases. For $1 million deal, it could be 30 to 40% instead of 20 to 30% for a $10 million deal. So really, from your point of view, remember, if you're going down market as well, the multiples come down, so does the seller financing. And that's why I put this little table here. This is kind of 2024 average multiples in the Canadian marketplace. As you can see here, the multiple is 2 to 4 times for a business that does about 100 to 500,000 in EBITDA. But as you go up, so as you go up to 4 to 7 million in EBITDA, that's a massive business. Well, then the multiples, the averages alone, start shifting up because of the size premium and the availability of financing at those larger transaction levels. So, really it 3X's in terms of valuation simply due to the size, the average size and the available financing. Okay. So, just a couple comments here, just to kind of round up mistake number 2. Another common mistake I see with high price valuations is that the broker or the SIM or the seller really sells you on the future. They say, oh, they have this contract, there's this coming up, there's this new technology, we're going to hit it out of the park. Here's my next 2 to 3 years of projections in the hockey stick growth. And so buyers pay off of future earnings. But really, from a risk mitigation point of view, your responsibility is to protect your capital, your friends and family's capital. And so really, most professional buyers pay off of historical earnings, be it the last trailing 12 months, the TTM, or an average of the last couple of years. Nowadays, especially in brokered auctions, I don't really see kind of a 4-year average. I usually see maybe 2 years. But maybe if the business is really growing a lot, you pay off TTM, but then you structure in an earnout. And the ability to use these earnouts to mitigate that future risk is key to structuring the deal correctly. So seller financing, it could be a vendor note where it's a fixed loan that you have to repay to the seller in a couple of years, or it could also be an earnout tied to future performance based on sales or EBITDA for how that business actually does in the next couple of years. But earnouts are a great way to mitigate some of the very common risks that you see in these smaller deals, be it high customer concentration, right? Customer 1 makes up 40% of the business, or the top 3 customers make up 80% of the business. Very common situations I see. It could be key owner risk, where there's no middle management team. The key owner, the sole owner, does essentially a lot of the major things in the business, and they're leaving the business, and you have to mitigate the risk because you may be able to transition some of it, but you haven't been there for 40 years, so you don't know all the skeletons in the closet. So that earnout is a great way to mitigate that risk. And then as well, this ramp up in earnings. Maybe you're trying to buy off of projections because the seller has a very high value expectation and you think it's a great business. So you pay off of those projections, but what you pay in terms of cash is more based on historical earnings with the upside shared via an earnout. And I've seen deals where earnouts are 10% of the value. I've seen deals where earnouts are 50% of the value, depending on how much is either historical weighted versus future projection weighted with this ramp up in earnings. Now, a technique, and this is what I usually do for a lot of these smaller businesses where either you're dealing directly with the seller or with an inexperienced or sloppy broker, is maybe what you do, you actually submit 2 offers. And so you actually see what the seller wants to do. So I've seen this, and it actually works quite effectively where maybe you say, listen, I value the business at a 4 times, but the seller really wants 4.5 times. So what you do is you say, I'll come in at 4.5 times with higher seller financing to meet your value expectations, or I'll come in at 3.5 times, but with almost no seller financing and all cash, and see what they really want. Do they really want that all cash number because there's more certainty to the cash that they get in their hand? Or do they want a higher price but probably with more structure? to really get to that higher price. And by doing that, you're actually kind of learning a lot about the seller to see, if they really grab and they're confident in their numbers, they're probably going to grab that higher valuation with more structure because they know they're going to realize on the future payments. Versus if they're actually conservative and they're not too sure about the future, they may gravitate towards the all cash offer more. So I wouldn't recommend doing this in a brokered, type auction where you're dealing with a proper investment bank. But if you're dealing proprietary directly with the owner and you really wanted to see kind of how they react to different structures, maybe actually put two offers in front of them and say, hey, listen, like, I don't know, I've run this by my bank. I can actually give you a little bit more cash down, but the valuation is going to be a little bit lower. Or I can give you a higher valuation, but I need more seller financing, so the cash down is actually lower compared to the other offer. So something to think about as well. And so the last thing is, this is a big one, and so we already talked about mistake number one, which is, working capital. So most sellers, they don't understand working capital. So you have to explain it to them. And especially if they don't have a broker who hasn't taught them about that, then they're going to really struggle when they sit in front of you and you say, hey, this includes working capital. They're going to say, well, what's that? No, hold on a second. Like the inventory, the accounts receivable, that's all my money. I mean, I put equity into the business to buy that inventory, to generate that AR. So I'm going to get paid on top of that. So, that's a bit of a educational discussion. And certain sellers will simply resist, accepting a price that includes working capital. So I've seen certain smart buyers, what they actually do is they actually lower the price. So before they even put in a price, they get an assessment of how competent is that seller in terms of their understanding of working capital, how much they're resisting accepting working capital as part of the price. And so maybe what they do is they actually position it as, I'll pay you $2.5 million for your business and then buy your working capital for another $500,000 to get you to $3 million. When in reality, you're always going to pay $3 million. You just position the offer in a different way. And I've seen that done in two of our transactions where the seller just had this resistance to, I can't give my working capital away for free, because that's the way they think about it. Well, you're paying for my business, that's price one, but then you have to pay for my balance sheet. So when we went to the buyer, we said, hey, listen, this is how you should position your offer so that you can actually show that you're attributing value to the balance sheet and making it feel like you're actually paying for both, when in reality, it's still coming in at about the same valuation that you would have paid for anyways on a multiple basis. So there's different ways to address that, but that's a big one. I would say working capital and how you position that with the seller is very important. Okay, so moving on to mistake number 3. This is another big one, especially for first-time business buyers, because again, there's a lot of pressure. There's a lot of pressures and there's a lot of different twists and turns as you go down the process of buying a business. And usually the closer you get to your LOI, the more you have in terms of cost, right? You have your lawyer fees, you have your accounting fees, you may have had search fees to cover your search for the 12 to 18 to 24 months that it's taken you. And so as you get closer and closer to the finish line, you look back and you say, wow, I have $200,000 in costs into this deal. And so you are comparing your deal and saying, okay, well, whatever happens in the deal that I have under LOI, option number 1 is I close on that deal, and option number 2 is I take the hit on the $200,000 in costs. Okay, and so they're comparing the two and saying, well, hold on a second, like there's a real limitation to me actually walking away from this deal because I'm going to incur those $200,000 in cost. But the reality is the sunk cost fallacy, that is already incurred. Regardless of whether you close the deal or not, you should not consider your costs. Because I do feel that there's that deal heat that happens where, these buyers feel so much pressure to close because they have all these expectations and dreams of getting into a business. And as the deal progresses and things come up in that deal that maybe, aren't really good, there's red flags that start popping up, issues like the TTM starts to decline. So in the last, 2 to 3 months, the sales volumes are really declining and quickly falling off of their highs. There's a key customer that was lost right in closing. So you sign the LOI, and then customer number 2, which makes up 30% of your business or 20% of your business, ends up walking away to another competitor. Or a key employee that you thought you were going to rely on to transition this business with walks away to take another job or retires. Or the seller, this is a big one. The seller lies. They lie about a diligence item, and you uncover it and confront them, and they say, oh, well, I forgot, and so the character of the seller starts coming into question as you're going through due diligence. Or you uncover a substantial error that was either, supplied by the M&A broker, the accountant, whoever was advising that seller throughout that process. So these are very common red flags that come up when deals start to fail. And so, from your point of view, you have to be mature enough to realize that whatever costs you incurred are separate from this discussion. At the end of the day, your analysis is between whether this is a good deal or a bad deal, whether this is a good seller that I should deal with and I want to deal with and I can trust, or this is a bad seller who's a snake, and snakes are going to get you in trouble. So put the costs to the side, forget about them. Even though they've been incurred and they are real costs, the difference between you closing on a deal and not should not be based on costs or how much time you've put into that deal. If it's a bad deal, it's a bad deal and you should walk away. And it's really hard to do that. It's really, really hard to do that. So I always recommend, and thankfully I get brung into these situations when certain buyers come to me and they say, "Hey Rob, I got a quick question for you. Can you tell me if this is normal or not?" And I tell them right away, that is not normal. Like, you should be, your sensors should be going up for that. So it's important for you as a business buyer, as you're going through your process, and especially when you have an LOI signed up and you're going down that process, getting closer and closer to closing, to have an advisory committee, to have investors and different bankers that you can use as a sounding board, so that when certain issues come up, you can remove yourself, because you are biased, remove yourself from that situation, put that question to your advisory committee and see how they react. If they're telling you to walk away, you should probably walk away. There's a lot of those stories out there about, I ignored everyone that was telling me I shouldn't do this and I did it. Well, the reality is you're hearing the 10%, the other 90% that failed and didn't have a book to write and didn't get covered in the news. Well, that's why they failed, because people told them they shouldn't do it. So from your point of view, your job isn't to kind of hit that home run. It's to try to aim for that first base hit, that second base hit, because this is your first business. You may buy more businesses, but if you fail on your first acquisition, you most likely won't buy your second one. It'll be harder to get in the capital, the credibility required to close. So your risk of failure is a lot higher as a first-time business buyer, and you really need to be comfortable with that, okay? So moving on to number 4. So this is, I've talked about working capital, and there's a separate video on net working capital analysis and, calculating the historical needs of the business. But at a very high level, most businesses, you can think of it in this way. A business has 2 different types of capital. There's working capital, which is the day-to-day operating funds of that business to meet payroll, to meet, any types of supplier payments, and in addition to finance ongoing, inventory and to finance the operations of that business. But there's also capital expenditures, where you're investing in new capital assets, equipment, IT assets, whatever it is, to really help you deliver that, that service or product in a profitable way, the same level of your competitors and hopefully above your competitors, so you can retain your customers. So growing companies, and this is the truth of it, growing companies can actually fail. There's a lot of good companies out there that just run out of cash. And it's very common in IT space, where the business itself, the fundamentals, the margins of that service offering and all of that, they're super high margins, and it's a profitable business if they had the cash. So from your point of view as a buyer, you need to be aware of what capital does that business need to operate on an ongoing basis from a working capital point of view, but also what do you need to spend on an ongoing basis to replace the capital assets within that business, to make sure that you're regularly investing in capital expenditures to maintain the competitive edge and the margins in which that business continues to deliver on that product or service. So, this is the challenge with most business buyers, first-time buyers, is that they don't have all the money in the world, right? They may have $500,000, $1 million to buy a business from friends and family, and so they put a lot of leverage on the books. But they also underestimate, and they look more at the P&L than the balance sheet. They don't really appreciate the importance of the balance sheet and how it relates to the P&L. Because the P&L is how you're going to value the business. The P&L is how you're going to pay for your debt that you put on the books. But the balance sheet is the fuel that supplies the P&L and allows it to actually generate the profit that you need to pay back your investors. So if you, say, for example, buy a business where you underestimate the working capital, you set the target too low, or, you look at the last 12 months and you take the average. But, and this is very common, in most deals, it's a cash-free, debt-free close. So the seller had a lot of cash on the balance sheet and was using their operating cash on the balance sheet really to fund working capital. And you underappreciated the importance of excess cash on the balance sheet. Well, then you could get into a situation where you actually run out of cash 1-2 months into your deal, and you feel pressure to take on receivable factoring or higher cost of capital to meet that gap, which puts more and more pressure on you. So it's a bit of a downward spiral where you actually undervalue the estimate or underestimate the value of that working capital. So how can you actually analyze that? Well, at a very simple level, it's important to understand the working capital cycle of the business. So on the customer side, what are your average days receivable in terms of how much it takes for you to collect on the receivables from your customers? How much do they pay you in deposits up front? How much is versus how much is deferred and invoiced over time? So if their receivables is, you collect it within 30 days, and then your payables, which is your supplier payments, if they expect you to pay within 30 days, then that's a fairly even cash conversion cycle because you collect within 30 days, you pay within 30 days. So you don't need a lot. But the bigger the gap in terms of your collections versus your payables, the more working capital is needed to fund that difference. So say, for example, and this is very common for automotive, for defense, for certain manufacturing sectors where the customer makes up a big chunk of your business and they know it and they take advantage of that through different payment terms. So in automotive, for example, you could be waiting 90, 120 days before you get paid. So your AR terms are 90 or 120, but your supplier terms are still 30. So that means that you sell something, you incur the payable, and then you are going to wait 3 to 4 months to get paid, but your supplier expects you to pay them within a month. So you need to have that excess cash available to first fund the supplier and then wait on your receivables to come in. So from your point of view, you need to make sure that, and this is one thing that most first-time buyers don't do, is not only do you raise the capital to actually finance your transaction and the purchase price, but also raise enough capital that you have some excess cash on the balance sheet. I think it's really good practice that if you're closing a deal for $1 million and you're raising $500,000 to meet that $1 million purchase price, maybe you raise $700,000 and have that excess $200,000 on the balance sheet day one, so you don't face these pressures right away. Yes, you have to raise more and that changes the return profile, but it also doesn't put pressure on you as the operator in that first year when the risk is at the highest point because you have the most amount of leverage, you're learning the business, there's a lot of just stuff that's going on in that first year during the transition. You don't want to put additional pressure on yourself by undercapitalizing the balance sheet. So it's really important to have that excess cash. The second one is CAPEX, so the capital expenditures. Now, the reality is most buyers, they don't really spend a lot of time analyzing the equipment list because they don't know it, right? Like you're a financial buyer, you're going to buy a niche business. You don't really know how many years, what's the useful life of that asset, what's the quality of that asset. So I would say there's surface level diligence done on the equipment and the asset side of the business whenever there's a first-time business buyer. But the reality is that can actually get you in trouble. And I've seen certain situations where it's an HVAC company or it's a commercial services type business, very attractive for these financial investors. But you look at the fleet list and you look at the 14 vehicles that the business operates and uses to deliver services, and all 14 vehicles are 20 years old, have 400,000 kilometers on the odometer. So are those vehicles really going to last for the next 3 years? Or how much maintenance does it take to repair the ongoing engine issues and the body issues for those cars? So from your point of view, you need to look at the equipment list and say, how many years can I realistically get out of these assets before I need to replace them? And then not only that, but there's an increasing level of repairs and maintenance tied to those assets. So if I have a car that, say for example, let's just use cars because it's very simple. So if I have a car that's 10 years old or I have a car that's 20 years old, the amount of money I put into each vehicle each year differs, even if it's the same manufacturer, because that 10-year-old car has a younger life and therefore doesn't need its engine to be replaced or doesn't have as many issues as that 20-year-old car. So really the repairs maintenance, which is a P&L item, is going to be higher for older assets versus younger assets. So from your point of view, you also have to factor that in. Say, for example, you do buy a business with a lot of old assets and you have no capital or you don't really project the need to replace those assets over the next 3 years. Just remember, your repairs and maintenance is also going to then trend up because those assets get older and older and older. And then as well, usually essentially the margin per job decreases because now your overhead costs are ramping up because it costs more to deliver using that type of equipment. So from your point of view, as a buyer, what you can do to anticipate that is actually get someone to do a quality assessment, a condition report on those assets, and actually talk to people in the sector and ask them, are these good assets? Is this make and model good year? How many years can I really get out of this? What is the ownership costs in year 10 to year 15 for this type of asset? And don't ask the seller that, but ask someone that's unbiased outside, that's related to that sector, that you can just use as a sounding board to anticipate your costs and the needs behind those CAPEX. And then what you need to do is then price that into your purchase price. So similarly, when it comes to working capital, you can mitigate your risk by setting the target higher and also raising more capital to have on the balance sheet. On the CAPEX side, if there is a need to invest in the equipment of that business and replace certain assets, then either you lower the price in order to factor in the expenses that are going to come up in the next 1, 2, 3 years to replace those assets, or maybe you lower the EBITDA using a CAPEX average. So if the business historically has invested very little in capital, but you forecast that you need to start replacing at least one car a year, well, then maybe you factor in a $75,000 hit to annual EBITDA to factor in the cost of that cash expense associated with CAPEX. So these are different ways to adjust the price down, but ultimately, and it goes back down to mistake number 2, which is you just don't want to overpay for a business if the capital assets are very old and they need to be replaced, because then you're putting more risk on yourself as the buyer than actually properly pricing the risk in terms of what it takes to support the growth of that business. Okay, so moving on to number 5. I can make a whole nother video on this. I'm gonna cover it at a very, very high level today in this slide, because I wish I could just sit down with business buyers and really talk to them about this. Okay, so mistake number 5 is really viewing the seller negotiation and the seller interaction as a negotiation rather than a partnership. The reality is you're going to be working with that seller post-close. So the level of aggressiveness and the way you approach those conversations throughout the closing process, the seller always remembers. It's not like they forget what was said in closing and then just clean slate, start working with you and start helping you after closing. So if you come in and you negotiate aggressively and you cut, and you start pointing out all the issues and you nickel and dime them, well, the reality is you're stepping over the dollar to pick up the nickel and you're penalizing your relationship with that seller. And that seller is going to be less likely to help you, less likely to invest that extra time and cost to support you post-close. So we find that the most mature and professional buyers use a white glove approach when really navigating the seller relationship. And so what does that mean? What does white glove mean? Well, number 1 is showing kindness. So the seller, and the reality is, they're almost like your client. You're trying to manage them to make sure that you can get your deal done. But the reality is sellers sometimes have this Jekyll and Hyde in them. Some days they're really good. Some days they may be a little bit more snippy and they push back and say, no, that doesn't work for me. I mean, I've incurred 40 years worth of risk and cost. How can you do this to me? So there's different things that they're going to say, and there's going to be different attitudes throughout the closing process. What you need to do as a buyer is just remain steady. And sometimes you have to ignore the comments. I sometimes the immature buyers, they take those comments to heart and they really then they start throwing comments back at the seller. That is just the last thing you want to do. Just realize that the seller is going through a lot, and they will sometimes say stupid things that you just need to ignore and move past. And it's better for you as well that you move past that and you don't dwell on those comments, because if you say a comment back, trust me, that seller will hear that comment, remember that comment, and hold on to that comment. Definitely. The number 1, another option here is over communicating. So, oftentimes when you're going through the process, you're going to be dealing with your bankers, with your accountants, with your advisors. The seller's going to be dealing with their advisor and lawyer and everything. But there's actually not a lot of direct communication that happens between the seller and the buyer. And that silence is very deafening for a seller. They actually worry a lot, right? Because when they don't hear from the buyer, there's this whole sales pitch that goes on to get to the signed offer. And then once you're in signed offer, certain buyers just go silent and don't really talk to the seller over the next 30 to 60 days. So it's really important for you as the buyer to really start to communicate and have regular touch points with the seller where, maybe you take him out for dinner or you have weekly calls just to catch up on the business and personal things. Maybe you just really engage with them in a way where respecting the boundaries of the broker that they're working with, but still having the ability to communicate, because silence is the last thing that you want to have a seller face when they're dealing with you, because they're worried about the boogeyman, or they're worried about, well, we're not hearing from them. Can they raise the money? Can they close the deal? Have they found something? Oh no, what's going on, right? Like I've seen so many weird reactions when it comes to the silence that comes from the buyer side. So really the best buyers just constantly communicate and over communicate. Another one is setting clear expectations. So it's business 101. Do what you say you'll do. Because the moment that a seller loses trust in you, if you say you're going to do something, you don't do it, or you do the exact opposite, and the seller loses trust in you, even the small things, they'll project onto the bigger things. If you don't do this really small thing, then really they're going to say, well, are they going to do the big thing? Are they going to, if you're not going to be able to deliver within a certain timeline of 30 days to do blah, and now how am I going to trust them to actually run my business? Or can they manage different projects? They're going to start doubting you as a buyer. So it's very important that you set clear expectations. Don't overpromise, underpromise, and overdeliver all the time. Just try to put yourself in the best possible light with that seller. And this number 4 here, very similar to kind of showing kindness, just that patience. The reality is most SME sellers, they don't have the systems that you would expect they would have in terms of gathering information, the quality of that information. So sometimes you have to be creative. Sometimes you have to be patient. You're going to ask for certain things and they may take a couple weeks. And sometimes I find that buyers hound the seller. They're, where is it? Where is it? Where is it? Where is it? And they keep asking the same thing. The seller knows what they need to do because, that's very important to them. But at the same time, the buyer keeps chasing the seller for the same items, and it makes the seller feel a lot of pressure. And the reality is most mature buyers will actually sit down and clearly spell out what they need and then just regularly touch base with them, but not hound the seller. There's a different way of communicating there and just showing patience and saying, hey, just checking in. How's that going? Okay, you're still sorting that out. Okay, that's totally fine. I'll touch base next week. Versus, hey, where's this? Where's this? Where's this? I need this. Hurry up. The bank is waiting for this. Where my lawyers are waiting for this. I'm incurring costs every week because I'm waiting for you. Blah, 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 blah. All these different kind of like aggressive approaches to getting information. It works. It's not like that it doesn't work, but it puts more pressure on the seller, and it also just compromises your relationship with the seller moving forward. Another practice that I just cannot believe how many buyers do this. It just amazes me, but please avoid putting negative comments or negative feedback in writing. So when you write to a seller, and can be very dangerous nowadays because the tone of your words can be interpreted in very different ways. If you write something and you say, oh, the seller seems very disorganized, blah, 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 you may be throwing that comment out just as a starting point versus the seller will read that and say, oh, the seller is very disorganized. And so the tone of that email can be interpreted and the gravity of those negative comments can be received in very different ways. So I almost say if there's ever a time where you do have to give feedback, where you do have to say something negative, pick up the phone and or meet in person to have that conversation. It may take a little bit more time, it may not be the most efficient way to do it, but putting things in writing that can be interpreted in the wrong way, I have seen a lot of deals go wrong in that way. I'm working on one right now where it's been a 2-year process to get to the closing, and the buyer made one comment a couple months ago that really questioned the credibility of the controller in the business, who's also a shareholder, and that controller has been holding on to that comment for months now. And she is unable to let it go, and it really clouds her judgment and her whole experience throughout the closing process. So I can tell you, I know that post-closing, that relationship is going to be compromised. It's not going to be the same way simply because of one comment in one email. So be mature. Don't put those things in writing. And then lastly, wield the hammer carefully. So obviously you are trying to get your deal done. You have to protect your investors and you have your risk to manage. And rightfully so, there are certain areas where you need to be a little bit more firm. But there's a difference between being firm and throwing that hammer or throwing that punch and being aggressive. The reality is sellers will match your energy. And if you start to negotiate aggressively, they will become more defensive. They will fall back onto their back footing, and they will start to push back. And so that just is not productive. So most mature buyers, they will be focused. They will provide feedback in a very professional manner, but they know when to not push. They know when to not be too aggressive to compromise the relationship with the seller. So that's it, guys. Hopefully you found the video helpful. And as I mentioned, if you do have any specific deals that you want me to look at, I'm more than happy to jump on a 1 hour kind of consulting session. Just book through the website and you can go there. As well, if you want to sign up for the newsletter, you can go on the website, sign up there. And if you have any direct questions or you want to reach out to me, LinkedIn is best. You can connect with me on LinkedIn, send me a message, and I can jump on there. Or you can comment below in the video below, and I'll try to respond as quickly as I can. But hopefully, you guys, you found the video helpful. And if you have any questions, please do reach out. Have a great day. Bye.